Tonight, we're going to take a deep dive into one of the most important and yet often overlooked indicators of financial market health: volatility. It's not all just about the returns, it's not all about the risk, it's also about the volatility. What is going on with that? What do we have? What does that mean? So let's take a look at these three important charts that I'm showing you. So the chart you're seeing on your screen, sourced by Cboe, ICE, and JPMorgan, is presented by Bloomberg and is titled "The Market Calm Prevails." Sounds great, isn't it? And as we head through December of 2025, that appears to be the story. Volatility is falling across equities, bonds, and currency. What does that mean? It means that everything is kind of slowing down. I mean, if you look at it, the lower, the better. So, but as always, you know, the surface level interpretation is rarely tells the full story. So tonight, let's ask you some deeper questions. First one is, why is volatility falling? Is this calm justified? Are markets becoming complacent at precisely the wrong times? And that's something that I've been saying all along, is that the more we talk about problem, the more we think that things are going to go bad. That is okay, because at least we are aware of the danger. Once we assume that everything is fine and nothing could possibly happen and the stock market is going to keep going up and up and up, that is when you need to worry. And this measure of the VIX and few measures of volatility is telling us that everybody might be becoming a bit too complacent. So first of all, let's understand what each index tells us. So you're looking at three major volatility benchmarks, each representing a different part of the global financial system. The most famous one, as everyone knows, is the VIX. Right? The VIX. This is the most famous volatility index in the world, the Cboe Chicago Board of Exchange Volatility Index, often called the fear gauge. When the VIX spikes, stock investors are nervous or hedging aggressively, and it's basically calculated using the S&P 500 options. Don't worry too much about the detail. All you want to know is it's a measure of volatility, how nervous people are. That is the question. What we're seeing here is a clear downward trend from late 2024, as you could see, right? From late 2024, last year, right? So it starts at December 2024, it shoots up, and then since then it's been going down quite a bit. So it dropped from intermittent spikes above 30 to 40 and all the way down towards the mid-teens. To the mid-teens. And that means that, you know what? Not concerned about the volatility. The second one, which is the treasury market volatility, well, this index measures rate volatility, and we know we heard a lot about rates, and you're going to hear a lot about it this week because the Fed is meeting again. So the heartbeat of global financial liquidity, the MOVE index, as it's called, is essentially the VIX for bonds. And it matters enormously because interest rate volatility influences everything from mortgage rates to corporate borrowing costs to global liquidity. Let me tell you why this is important. This treasury market volatility was the one, you may or may not realize it, but put a stop to the original tariffs mayhem of the beginning of the year. Remember in April, Liberation Day, when we say, hey, you know what? Everybody gets a tax. Everybody gets a tariff. And the market went ballistic. But at that time, the U.S. administration said, you know what? I am with Main Street, not with Wall Street, so I do not care. But as the issues started developing in April, and they realized the mayhem and the issue that this was caused, the volatility, the uncertainty, that the rate on the 10-year yield started to go up. 4.5%, almost 5%. That was a signal that people were dumping the U.S. Treasuries. And when that happens, that increases the yield that the U.S. is paying on its $37 trillion worth of debt. And that, my friends, that put a stop to the tariffs. And then they came back and said, you know what? Let's give it a 90-day preview. Remember? So I don't want my subscribers to underestimate the move index, because that is very important. I want you to understand that. So, the move index. The move index is essentially the VIX for bonds, and it matters enormously because interest rate volatility influences everything from mortgage rates. Your mortgage is tied to the 10-year Treasury rate. Okay? So that goes up, your mortgage goes up. The chart shows a dramatic come down from the peaks of near 140, as you could see, in the late 2024 as well. That's as you could see, that's a middle chart. The middle chart is basically showing you what is going on. And that is a massive normalization, and it coincides with the Federal Reserve signaling that the rate hiking cycle either paused or fully completed. That's it. Then, number 3, further to the right, what you are seeing the JPMorgan Global FX Volatility Index, the currency market stability. The FX markets reflect capital flows, geopolitical risk, and growth expectations. A decline in FX volatility from, you've seen, the 10 to 12 towards the 6 range suggests that investors in currency are stable and predictable. Makes sense. This is especially notable in a year with geopolitical shocks, tariff battles, and shifting alliances should, on paper, create more dramatic currency swings. Why is this not happening? Aren't you scared? Aren't you concerned about a war? After all, we have all these things happening, and yet it doesn't seem to be an issue on anybody's mind. Why is that? I guess no one is concerned about Ukraine. At the end of the day, what everyone should be concerned about is China. For the U.S., the U.S. is very concerned about China. It is annoyed by Russia, but it fears China, and that is not your hearing. Okay. So, but right now, everybody says, you know what, this is not a big deal. I think this thing is going to get resolved itself. And don't forget, these rates just don't get set on Monday morning. They get set by thousands and thousands and thousands of analysts analyzing, like we're doing right now, try to understand what's happening and buying and selling accordingly, therefore doing price discovery. So why are all 3 volatility measures falling together? Why am I asking that question? Well, I'm asking that question because it is very, very rare. For volatility to fall across all 3 major asset class simultaneously, when it does, analysts look for underlying forces powerful enough to calm global markets. So let's see what they are, if they make any sense. So there are several plausible explanations for such drop in volatility. A, the Federal Reserve has stabilized rate expectations. Right? I mean, we'll see, but the biggest drivers of volatility in 2020-24 was the Federal Reserve aggressive tightening cycles. When the central bank moves unpredictably, markets become disorderly. By the late 2025, Fed communication may be clearer, forward guidance more reliable, and inflation prints less erratic. Or, as we could see, frankly, is that The U.S. administration has set the tone, and it's getting what it wants from the Fed. When rate expectations anchor, bond volatility collapses first, which is exactly what the MOVE index is showing. And historically, when bond volatility cools, equity and FX volatility tend to follow. What else could be a possible explanation? Second one, algorithmic and passive flows dominate market structure. A modern structural explanation. Index funds continue, absorbing flows. Option writing strategies, including zero-day to expiration option, increase market volatility and liquidity. The 0 days, basically those new S&P index options that expire the same day. Systemic volatility, sellers dominate, and dealers are long gamma, keeping indices pinned to tight ranges. In other words, the market plumbing itself is suppressing volatility. So much liquidity out there. This doesn't mean it's healthy. It just explains the phenomena. And remember, what I'm doing is basically this channel, and don't forget to subscribe and to also join my Patreon channel for more information, more detailed recommendation. But basically what this channel does is it actually looks for risks in the market. Try to understand what is going on. Believe it or not, what these people are doing impacts you. You better understand it. And that's what I'm here for. I am here to explain to you what is going on and what I think is really going on. They don't tell you any of that. Number 3, as to why we should see such a drop in volatility, weak macro news flow reduces uncertainty. Markets behave like living organisms. They respond not just to data, but to surprises in data. If the macroeconomic numbers, employment, inflation, GDP are coming in near expectation, investors recalibrate to a calmer environment. This reduces the need for hedges. Also, another reason why we have such low amount of volatility is a global governments intervening in trade rates and liquidity. In recent years, the US, Europe, and China have used tools such as liquidity injections, targeted fiscal programs, currency management, strategic reserve releases, and these actions smooth the shocks. A smooth market becomes a quiet market until those interventions reverse. So what are we seeing? What you're seeing is that the very heavy hand of governments kind of putting out liquidity out there to calm the masses. Now, is low volatility a good thing or a warning sign? Right? Let's shift to the more important question. If this calm is a legitimate sign of market health, or is it quite before the storm? The history is mixed. Right? I'm showing you, look, it was low liquidity, so we should be fine. Well, let's see. In stable economic expansions, volatility naturally declines. In 1994, 1999, 2012, 2017, these things have happened. Right? Low volatility. So in these periods, in a benign interpretation, the market is telling us no recession is coming, policy is predictable, risk is manageable. Well, sounds great. Also, low volatility can also signal complacency. And that is what I'm telling my subscribers and I'm telling my Patreon members to be very careful. The complacency, right? That worries institutional risk managers such as myself. Periods of extremely low volatility have preceded major shocks. Beware of coming waters. The VIX was unusually low in 2006 and 2007, and we do remember what happened after that. Before the global financial crisis, FX volatility collapsed before the Asian financial crisis. Treasury volatility fell sharply before sudden debt downgrade scares Why is that? Because markets misprice risk when volatility gets too low. When there's all these people are doing all day long, they are pricing the risk. They're pricing the risk. They're doing price discovery, valuation discovery. Is this, if I'm selling at 50, any buyers at 50? Wow, I buy at 60 and 70. Look at yourself at what's going on with Bitcoin right now. Right? Bitcoin right now is not doing so great. Right? I think it's at about 90,000, 89, 90,000. So the point is that such amount of liquidity means the market is complacent and does not know if there's not enough activity. It cannot price what it cannot see. That means, my view is that, okay, so it's not happening in December and January, but you have to be careful about the coming year. The signals are there. I think we still have more to go in the stock market, but this is not going to be a straight run. And if you look at my Patreon channel, you see that I've started to kind of lighten the load a little bit on some of my assets in my portfolio, just because I think that, let's not be totally invested. Let's not sell, but let's not be fully invested at this point. So this is because market misprice risk when volatility gets too low. Investors stop hedging, leverage increases, correlation structures break down, and this is known as a volatility paradox. Basically, like you're living in Florida, you see the storm coming, come on, it's not going to happen again, so I'm not going to insure my house. That's kind of the idea. The chart's synchronized decline across the VIX, the move, and the FX volatility raises eyebrows. It's rare. It's not so much because it's going down, but just all three of them. And historically, synchronized suppression raises tail risk. The fat tail risk. That is how you could make a lot of money, obviously, because right now it is very cheap. Listen to me. It is very cheap for you to buy puts on the S&P, long-dated S&P, because everybody thinks the market is going to keep going up. But I'm telling you, maybe it could be time to start hedging this. How do you think Spitznagel and Universa and these people made 4,000% during COVID? By hedging the tail risk. The risk that no one sees coming. How do you think, right? How do you think our friend, how do you think our friend made money during the financial crisis? Okay. What's his name? Michael Burry. That's how he made money. He made money during that time. So let's see what could break the calm. What's going to give rise to, oh my God, we are in trouble. Oh my God, we are going to have a crash of some sort. Well, policy surprise from the Federal Reserve. If you have a sudden shift in inflation trajectory, employment numbers, recession signals, or political pressure, that could force the Fed into unexpected action. Any deviation from forward guidance would send moves surging first, and then equities, and then FX would follow. What could break the calm? Two. What I'm saying is the geopolitical events. 2025 is a year filled with geopolitical fault lines. We have US-China tariff escalations, Middle East security tensions, Russia and Ukraine negotiations, right? All of these things could be happening, and all of these things could become an issue. What else could happen? Well, number three, you could have what we call the capital flow reversal. If foreign investors reduce allocation to U.S. assets due to deficits, debt concerns, political instability, this could pressure the dollar, treasuries, and risk assets. Volatility across all indices would normalize, but upward. Corporate earnings shocks, although I don't think it's happening right now, but markets are currently pricing smooth earnings. One major miss from a mega cap could spike the VIX instantly. Liquidity withdrawal. If central banks quietly pull liquidity from the system, even without changing interest rates, volatility would rise. Low liquidity amplifies even minor shocks. So what would investors such as yourself take away from this? Well, markets are calm, but not because risks are low. That's one. The calm feels engineered. Smoother policy signals, algorithmic liquidity, lower realized volatility, compressed risk premium, but underlying risk remains high. 2, cross-asset volatility falling together is unusual. This suggests the entire global financial system is synchronized. History teaches us that synchronized systems are beautiful on the surface and brittle underneath. Number 3, investors should not confuse calm with safety. A low VIX does not mean low risk. A low move does not mean the rate cycle is over. A low FX volatility index does not mean geopolitics are stable. It simply means markets have stopped pricing uncertainty for now. Meaning I can't price, there's not enough takers. Nobody wants to price the uncertainty. Volatility reawakens suddenly. That could be the risk. When volatility returns, it does not creep higher, it jumps. So, yes, volatility has collapsed across equity, bonds, and currency. That's great. The market today appears serene, but seasoned investors such as ourselves know that surface calm often masks deeper undercurrents. As we move into 2026, the question is not whether volatility will return, but what catalyst will bring it back and how prepared investor will be when that moment arrives. So I am telling my subscribers and my Patreon channel that 2026 to be watched very, very carefully. Yes, you can make money in the market because the market is going to keep going up for the time being. But it is highly, highly susceptible to a surprise. Another surprise that I've just listed. I mean, yes, we're going to have lots of help from the lower rates from the government, from the Fed. We're going to be helped by the big beautiful bill. We're going to be helped by the fact that tariffs are not really impacting the economy that badly because they're not messing around with the U.S. All of these things are going to be positive impact, but the market is becoming complacent, and of course you have all the AI bubble that's keep pulling up. It's not going to explode soon, but when it does, you want to be protected. So you have to. That's why you need to follow me. You need to understand what's happening a little bit at a time, so you can have a feel. Don't wait for me to give you the answer. I have the answer. I could tell you these are the signs. You need to watch the signs. And the signs are everywhere. Okay? So,